Well, good morning and welcome to this week's Market Carver. I'm Joe Clark, the managing partner. Happy to have you along if we haven't met. Hey, this is going to be an interesting Market Carver, and here's why. The markets aren't happy. They're frustrated. They're having some issues. You know what? We have about 1,077 families that we take care of that receive this on a weekly basis. About 120 of you watch it religiously. But when we have interesting things like a Brexit or a Trump election or a Trump not getting reelected or a period of time in the market like this, we're going to have more viewers than ever. So that's always exciting for me to be able to share stuff. Now, we are in the month of September. And that may sound interesting to you. It may not. But here's the bottom line. Markets have seasonality behavior. September is the weakest month. This is not something that is a surprise to us. It's something that we manage around with our risk barometer. We look for opportunities in this period of time. And so the frustration that comes out kind of can get a little overheated at periods of time. Now, for those of you who like to watch the news, and I'm openly honest with this, I quit watching the news in '09. I think it moves people's emotions, certainly moved mine, and I need to be focused on our discipline. That's what takes care of our nest egg. Make sure that you guys are in the right place, the right position for where you need to be. But one of the biggest stories that going on right now is what's happening in China. And it's essentially Evergrande is their largest property developer that's going on inside of China. Now, we know China's got issues. We know COVID started there. They're still having challenges. The red line is the Hang Seng Index, so you can see their market has kind of gone sideways all the way through 2020, not near the growth that we had in the United States, actually a little bit negative. But the bottom is just a shareholder wipeout of this company that's going on over there. And it is a big company. Again, it's their largest property developer. You have to understand that CNBC and the media make money by providing news that attract your eyeballs so they can sell commercials. And so they're going to make a bigger deal out of this than what it may really be. But this is potentially a financial crisis similar to what we had in '08 and '09 existing inside of China. So we will continue to watch it and monitor it. That's what you pay us to do. But that spillover in the junk bond yields is the highest we've seen since March of 2020. So we're back to pandemic levels. So what they're looking at from their market perspective is this is serious stuff. Inflation follow-up. Now, I've told you, I have never in my career, 33 years, 34 years now, I have never seen such a widespread of belief from people that are very well educated, very well informed, with lots of experience as to whether or not we're in an inflationary period or not in an inflationary period. What I will tell you is the numbers that were coming in were clearly inflationary driven. The numbers that came in this last month that you're able to see on that chart right now actually indicate that inflation is kind of slowing down. Now, some of you are going to hear this and go, now, wait a minute. One of the families we take care of says, hey, when I have to pay 30 to 40% more to build a widget, don't tell me that there's no inflation. I get it. I feel the same way. I tend to believe that inflation is probably going to be with us for a longer term period of time. Adam believes it's what we call transitory. So again, there's a widespread here, but that is the data. That's where we are. A lot of what's going on is what's happening with the Federal Reserve. The recent underperformance of the IG, that's investment grade risk factor, has essentially put an end to 9 years of uninterrupted positive returns. When we manage bond portfolios, and you've heard me, if you've been in meetings with me or if you've been at a Thirdly, my biggest concern is being able to measure around the fixed income space in terms of what's going on. But you're actually starting to see those negative returns that are coming in a large part because of the Federal Reserve. Now, when we look at the S&P 500 daily, and I tell you not to watch this daily, weekly, or monthly, it's an interesting thing to me. One of my friends came up at the golf course on Saturday and said, Joe, I just want to talk a little business real quickly. Like I said, we take care of more than 1,000 families in 31 states. And when you're new to the firm, you don't understand our process and everything else that's going on. I get it entirely. And asking those questions is fine. That's what you have an advisory team for. We are more than happy to help. The people that have been with us for 5, 10, 15 years, they don't ask these questions because they understand that we have a process. We know how to behave in a disciplined approach. There's nothing erratic. Adam and I like to say there's no heavy breathing. Right? This is all planned out, plotted, and we are ready to respond accordingly to what's going on as opposed to react emotionally to what's happening. But when you look at the S&P 500 daily, it is beginning to break down and break some of those numbers. Again, it is September. When we look at breadth, again, you're starting to see some of the problems. The number of stocks above their 200-day moving average is still declining. That red line at the bottom of the chart is working its way down. The third line up, the number of stocks that are above their 200-day moving average is breaking down to a new low. That is not a good sign for the market. Now, does this mean we're going into a bear market or a 20% correction? Not at all. All it is telling us that, hey, there's a little more risk right now than what's going on. And again, when you look at 6-month highs and lows, you're beginning to see that same thing. The chart at the bottom is 6-month lows. You'll notice that it's working its way higher. That's not good. 6-month highs is still a flat line, if anything's trending down. Again, not good. Now, here was an interesting thing. These last two charts that I'll get with you, the monster inflow of money. Global equities took in $51 billion last month. I'm going to talk about this at the Thirdly. If you're not in attendance for the Thirdly, you at least want to make sure that you watch the video that will have parts from me, parts from Adam, parts from Aaron, our Director of Financial Planning. That will come out right after we do the Thirdlies. But we had this monster flow of money, that orange line that showed up. And that just shows you the capital that's on the sideline. Now, you contrast that with the biggest outflow at the same time. And that's where you saw $39.7 billion actually pulled out of the market. So we had the largest in history money that went to the U.S. large cap funds last month. So think S&P 500, if you will. Again, I believe that is a 401k story. I believe it is market, not timing the market, but the time when money is received in the market. We will be talking about that at the Thirdly. But we have a lot of people on different sides of this coin right now. And where you get into trouble in markets is when everybody is on the same side. In the best case scenario is everybody believes the market's going to zero. That's a great opportunity. When everybody believes the market is just going to go higher and higher and higher, that's time to be scared. Right now, you clearly have this contrast. In an inflation, you have the contrast in terms of where money is being invested. It is a very, very interesting period of time. If you want to know more, don't forget to join us on Consider This Program. That's our radio show. You can find us anywhere you listen to podcasts. Saturday mornings rather at WIBC, Shine 99, WHBU, WILO. Happy to have you along. If you have any questions or comments at all, please don't hesitate to share it. Have a great week. We'll see you again soon.